what these are is if you work for a corporation or a company, right, they are employer compensation plans. Okay, that basically they contribute and so do you. So you have the employer contribution and you have your contributions, right? You either get matched or something like that for a certain percentage that you put in over the lifetime of when you're working for a certain institution or corporation. Okay, now 401ks are not meant to be in a 401k when you retire. Okay, or really 2 years before you retire. I don't believe, and I know, Steve, you agree with me on this, okay? A 401k's main goal is to be able to plug in money, right? You are literally buying the stock market money or whatever mutual funds or index funds that you're in inside of that 401k until you actually get to the retirement phase, all right? And why that's important is because I've been seeing so many clients that have been retired for a year or two or looking to retire, and their 401k is so high. And I'm like, hold up, what are you doing? The rollover mechanism is one of the most important things when you get into the retirement phase. Okay. And why that is, and I'm going to let you talk about this too, but why that is because you have been working your entire life and plugging in and buying every dip in the stock market with that 401k. You have bought when you were 20, 25, 30, 35, 40 years old. Okay. And two, all those bubbles have now accumulated what you have. Now you're changing the entire phase. You are now changing into what? The distribution phase. So the rollover part is the most important thing that you will have in your life if you have a 401k or if you've rolled over a 401k, that's still important now. Okay. Now, the transition process is very simple. Okay. You're transitioning and rolling it over into an IRA, right? Which means an individual retirement account, right? So now that gives you a lot more options. Now, Steve, I'm going to let you answer this. What's one of the most common mistakes you see after or when someone rolls it over?
Well, the problem with rolling it over is there's really the best way to do it is to have a rollover go into a new IRA account with another company. If clients decide they want to roll over a 401k and take the money paid to them, then the institution where the money's coming from has to hold back 20%. Then they pay the money to that person. And then what happens is they have to claim that as income and pay tax on it, unless they do a personal rollover where they take the full amount and they reinvest it within 60 days back to an IRA. So the problem with doing it themselves is there's going to be a withholding of 20%. When they decide they want to reinvest it, it has to be 100% of what they took out, including the 20% they didn't get. And they have to do it within 60 days. So there's a lot of complications. A lot of mistakes are made when somebody tries to do it on their own. What we try to do, and I've seen you do it better than anybody, David, is really getting on the phone with the 401k company, figuring out where, before we even decide to do a rollover, where that money is going to be positioned. What is the goal of the client? If it's income, we're going to an income vehicle. If it's growth, we go to a growth vehicle. But then you set it up where it's real simple. You get on the phone, you expedite it with that company. They roll it over. They send a check. The client doesn't get any money withdrawn. The check's made to the new investment company, and we overnight it to that company, and there's no issue with taxes. Right. So I've seen you keep it very, very simple when other people have making it more complicated. And I think that's where we can help people. If they come in, they have a 401k, what do I do? We're going to meet with them, go over their goals, talk to them about how to do a rollover the most tax efficient way in the simplest way.
Right. Don't you? And that's, and I'll tell you a mistake that I see too. One mistake that I see a lot of is people rolling over into something they have no idea what they're rolling over into. And why
or let me add, they rolled out from this fire to another fire.
Right. Right. And it's like, that's not what a rollover is, right? There's a couple things that are important about a rollover. Number one is versatility. It gives you more versatility on what you want to go in your investment vehicles for retirement, whether it's an annuity, whether it's more stocks, whether it's bonds, whether it's specific REITs, right? Whatever you want to go in, it gives you the ability to do that. In a 401k, you only have a limited amount of options.